So today we'll discuss RBI and monetary policy. So monetary policy is one of the very important topics of economy. Okay, so before going to discuss in details about the monetary policy, so just I want to discuss about the money and what is the role of money. Okay, and what is the definition of money. Okay, and all of you know that initially there was no money was not introduced. Okay, and then we have the existence of barter system. So what is barter system? Means here actually transaction takes place, okay, by means of exchange of goods. Suppose there is a person say, okay, so he has produced surplus of rice and but he needs potato. Okay, and suppose there is a person B who produced surplus of potato, okay, and he needs rice. So in that case they can exchange. Okay, so exchange can take place among themselves. Okay, so this is a barter system. So before the invention of money, so barter system was there through which goods are exchanged between the different individuals. Okay, but we know that there are different challenges to this barter system or drawbacks of this barter system, because first is that we know that the goods cannot be stored for long period, because all these goods are perishable in nature. Okay, so that is why, and first that is the first challenges. Second challenges is that, so when suppose this person want to transfer the surplus of potato or surplus of rice to person B, then there is the cost associated with the transaction. Okay, means transaction cost is very high. So that is why this barter system was very complicated. So gradually this money this developed. Money is concept developed, and money is nothing but it is a universally accepted medium of exchange. So the meaning of money is it is a universally accepted medium of exchange. Okay, so based on the okay, so the different countries may have different currencies. Suppose in India we have rupee. Similarly in the US they have dollar, then European Unions they have euro. Okay, so different country may have different currency. Okay, and but again this currency value may the value of this currency may vary. Okay, suppose we know that at present $1 is equal to around 84 rupee. Okay, $1 is 84 rupee. Okay, similarly this rupee may have different value as compared to this is called your exchange rate. So this is called your exchange rate. Okay, this is called exchange rate. So we'll discuss in details. So what are the factors, okay, that actually determines the exchange rate between currencies, okay, of two countries. Okay, so exchange this suppose now is $1 is 84 rupees. Okay, and sometimes this $1 may also becomes 90 rupees, and sometimes this $1 may also become 70 rupees. Okay, so when actually there are two concepts. One is depreciation and devaluation. So okay, one is depreciation and next one is your devaluation. Okay, so actually there's the basic difference between depreciation and devaluation is that when the money value actually decreases, okay, as compared to the dollar. Okay, so this is called depreciation as well as it is called both depreciation. The meaning is same. Okay, but thing is that devaluation is done by purposefully by the central bank of a country. So in case of India, so this depreciation is done by Reserve Bank of India, RBI. Okay, so what is the main objectives of this devaluation? Actually it is done by RBI in order to promote export. So main objective is to promote export. Okay, promote export. Whereas depreciations, actually depreciation there is no rule of a particular country. Okay, in depreciation actually depreciation is determined by international events. Okay, so actually you can say, so during the Russian-Ukraine war or during COVID pandemic, so the value of Indian rupee again further decreases as compared to the US dollar, because during the during the Russian-Ukraine war, okay, which has affected the entire global supply chain. Okay, as a result we know that India also import different products from Ukraine. Okay, so due to the since the Russian-Ukraine war, okay, has blocked the international trade. Okay, so that is why India has to import all these essential products from different countries, so which has led to increase the India's import bill. Okay, so depreciation actually it is determined by this is international issues, whereas devaluation is done by the Reserve Bank of a country purposefully. In case of India, it is done by RBI. Okay, so just to promote export. Now, actually, we know that India is an import-dependent country. It means our import is more as compared to export. That is why we always have a trade deficit. Our trade is not surplus. If we see our balance of payment, where there is two accounts, current account and capital account. So under current account there is a trade account. Okay, so where our balance of trade is always negative because our import is more than our export. Because till now, okay, we are not able to. India is not able to become a self-sufficient country. So we have to depend on different product from different countries. And we all know that 85% of our required crude oil, it is imported from different countries like US, Iran, then Russia itself. Okay, that is why India has to India has to pay a huge amount of money as a import bill. Okay, so devaluation is done. Suppose now $1 is equal to suppose 80. So when devaluation will be done, and suppose $1 becomes 85. Okay, so in this case, suppose why devaluation is done? So as I have already told you, devaluation is done purposefully for short term to promote export. No, so suppose by exporting, suppose an Indian company by exporting $1, no. So suppose by exporting $1 to other country, so it is earning rupees 80. So when devaluation will be done, exporting the same product, suppose same product, so it will earn 85 rupees. Means there will be more profit to the company. So as a result, there will be more competition among the different among the companies to export more. Okay, the thing is that India is so it will also have a it will have a positive impact in the export, but it will have a negative impact in the import. Okay, because when devaluation is done for long term, it will have a negative impact on the import because India import more as compared to export. No, so that is why this devaluation is done purposefully for short term in order to promote export. It cannot continue for long because if it will continue for long, it will impact our import bill. Okay, which will lead to balance of payment crisis. All of you know that in 1991, India faced the balance of payment crisis. So balance of payment crisis. Okay, so means our foreign exchange reserves was very low. Okay, so we have at that time only we have foreign exchange reserves to fulfill only around 7 days of import bill. So as a result, so India was forced to accept LPG. It is liberalizations, privatizations and globalizations. Okay, initially Indian economy was very closed. After 1991, Indian economy was open up. Okay, it was forced to open up because IMF will help the member countries during the time of economic crisis. But there are some conditions. Okay, until and unless these member countries not fulfill those conditions, they will not give this recovery these loans. Okay, so that is why India was forced to impose LPG in 1991 during the time of balance of payment crisis. So those are we'll discuss when I will discuss balance of payment crisis. Now I again back to monetary policy. Okay, so money it is already you know that it is a universally accepted medium of exchange. Again, there are two types of money. One is a legal tender. So money is called. So what is legal tender? So if you see in India, rupee is a legal tender. Means if we cash is a legal tender. Suppose if we move to the any market, if we buy something, if we provide cash, then they must accept money. Okay, so because money cash is a legal tender, but check and demand draft. So these are not legal tender. It means this check or demand draft may be accepted or may not be accepted by the shopkeeper. Okay, but money must be accepted or cash must be accepted. So cash is a legal tender. Okay, so this is about your money. Okay, again another concept with money is your demonetization. We know that in 2016 or 17, no, so the old this rupees 500 and the 1,000 notes, no, they were declared as they were demonetized. Means these were not become a legal tender. So demonetization means nothing but it is a process through which money in circulation cease to be a legal tender. Means they cannot be accepted. Those money when this all rupees 500 and 1,000 notes are not legal tender at present because they are demonetized. Okay, they are not if they are not accepted, no, so we cannot challenge in the court. Okay, so this is about your about the money. Okay, now if you see the Reserve Bank of India, so it was established first in 1st April 1935 on the recommendation of Hilton and Young commissions. Sometimes this may be asked, okay. So on the recommendation of Hilton Young Commission, this Reserve Bank of India was established in 1935, before independence. But it was nationalized in 1949. It was nationalized only in 1949. And if they ask who is the first governor, so first governor of Reserve Bank of India is Sir Osborne Smith. So was the first governor of Reserve Bank of India, and first Indian governor was C.D. Deshmukh. Was the first, okay. Now, what are the major functions of Reserve Bank of India? If you see the major functions is first, operating the monetary policy with the aim of maintaining. Okay, so I have already told you that the main objectives of RBI is to this monetary policy is actually regulated by RBI. Okay, next, market borrowing. So RBI also borrow money. Okay, so we know that government always have a deficit budget. So in order to fulfill those extra money, so RBI used to borrow money, okay, from the market. Printing of money, RBI also print money, and custodian of foreign exchange reserves. All the forex reserves, or you can say forex exchange reserves, are regulated by Reserve Bank of India. Bankers of the banks means all other commercial banks, whether it is private bank or public bank. So these are actually regulated by RBI. Bankers of government. So RBI also the bankers of the government. Okay. So these are the main functions of RBI. Okay. So now I move to the this main topic, that is monetary policy. Okay. So market borrowing impact of, okay. So okay, again you see monetary policy. I have already what are the main objectives of monetary policy? So first, so main object, there are actually three objectives of monetary policy. First one is to control growth. So first objective is to control growth. Okay, so to control growth. So second objective is to control inflations. To control inflation. So inflation is nothing but price rise. To control inflations. And third objective is maintain liquidity, money supply. Okay, so maintain the liquidity. Okay, so maintain liquidity in the banking system, so money supply. And if we see the RBI, so RBI wants to maintain inflation within the 4 plus minus 2. Okay, 4 plus minus 2. So okay, so the objectives of RBI to contain inflations in our country within the range of 4 plus minus 2. Okay, so inflation means it is a when there is a continuous rise in price of essential commodities, okay, for a long period, that is called inflation. And control growth. Okay, so these three are the, and maintain liquidity. These three are the main objectives of monetary policy. Okay, now you see monetary policy, it is determined by a committee. There is a monetary policy committee. Actually, initially the monetary policy was solely determined by RBI. Okay, but later in 1617 there is a sense. Okay, so sense is that the government has formed a monetary policy committee. Okay, so monetary policy committee which consists of 6 members. So 3 members is from RBI itself, and 3 independent members which will be appointed by the government. Okay, and it will be headed by this monetary policy will be headed by governor of RBI. Okay, and it when there is a tie, suppose there is a 3 members supporting some decision and 3 members are not supporting. So this is a condition of deadlock. In that situation, Reserve Bank of RBI will have a casting vote. Okay, but thing is that before the formation of monetary policy committee was formed in 2016 or 17. So we know that Reserve Bank of India is a autonomous body. So, but after the formation of this monetary policy committee, autonomy of Reserve Bank has actually diluted. That is the main reason why two governor of, we all know that Raghuram Ranjan sir as well as the Urjit Patel, no? So these two RBI governor has resigned, okay, in protesting against this monetary policy committee, because monetary policy, after the formation of this committee, we have seen that in the monetary policy committee there are 3 members from RBI and 3 members from government. Means autonomy of RBI has now diluted. Okay, so that is the reason, okay, why 2 former RBI governor, that is Urjit Patel and Raghuram Ranjan, okay, they have resigned. Okay, so now this so I have already discussed what are the main objectives of monetary policy, and next we will discuss what are the tools, okay, tools used by the RBI to control the this monetary policy. Okay, so liquidity management, I already know what is the liquidity. Okay, next, first one is a cash reserve ratio. First instrument that is used by RBI to control liquidity is your cash reserve ratio, or CRR, cash reserve. So what is cash reserve ratio? It is the amount of cash that every commercial bank, whether it is private or public, okay, whether it is public or private, they have to maintain within the RBI. So before going to discuss this, let us discuss one that is the funds, means the way now how the Indian banking system works. Okay, suppose this is a bank. Okay. Okay, and so in the banks, so there is the customer deposits money, no? So the customer says there will be one customer, two customer, there will be n customers. So customer deposit money and the banks gives loans. Okay, so this may be one two loan, or it may be education loan. Okay, it may be education loan. Okay, so it may be a home loan, it may be a car loan, different types of loan. Okay, now see, we the customers, now we deposit money. So these are the liabilities of the banks. Okay, so these deposits are the liabilities. Okay, these are the liabilities of the banks. Whereas loans, so whatever loans given by the bank, these are the assets of the. These loans are the assets. These loans are the assets of the bank. Why? Because we know that giving loans and earning interest from these loans is a prime source of income of all banks. Okay, so and these deposits. So deposits are the deposits in the banks are called liabilities. Why? Because at any moment when the customers come to the bank, so it is the responsibility of the bank that they have to return the money. Okay, so again, if you see the deposit, there are two types of deposit. One is your demand deposits. One is your demand deposits. So one is demand deposits and other one is time deposits. Time deposit. So demand deposit, example, saving accounts and current accounts, and time deposits means fixed deposits. Fixed deposits. Okay. So when maybe deposits for 5 years, 6 years, 10 years, etc. So there are two types of deposits, and this one is demand deposits and second one is time deposits, and these together known as net demand and time liabilities. These together they are known as net demand. So net demand and time liabilities. Net demand and the time liabilities of a bank. Okay. Or net and NDTL. So both the demand deposits and time deposits within the banks, they are known as net demand and time liabilities of the bank. Okay, so all the customers, they deposit money in the bank. Okay, these are the liabilities of the banks, because at any moment when the customers will come, so it is the responsibility of the bank that they have to return the money. Okay, next assets and all the loans, because whatever deposits the bank take from the customers, the bank know that they all the customers will not come at the same time to withdraw, no? So they use their money to give loans, and from this loan they also earn interest, and this is the prime source of income of the bank. That is why these loans of the banks are known as they are the assets. They are the assets. Okay, but if there is no regulating authority to control this, no, so this bank will try to give as much money as they want. Means they will try to give as much money as loan as they can. Okay, because this loan is the main source of income of the bank. So that is why in order to control this, so the role of RBI now start. Okay, RBI limits. Okay, RBI limits, and that what is the amount of money that every commercial bank can actually forward as a loan. So it is limited by the RBI. So one instrument that is used by RBI is your CRR, cash reserve ratio. So this cash reserve ratio, it is the amount of cash that all the commercial bank, okay, that has to maintain with RBI in the it is a so it is the amount of cash that all the commercial bank that has to keep with RBI, within RBI. Okay, suppose this is a commercial bank, so SBI. Okay, SBI is a commercial bank. So the amount of it has to maintain some amount with RBI, within RBI. Okay, so in the form of CRR, that is cash reserve ratio. Okay, so before giving loans to its customer, the different types of loans are any commercial bank. I just assume that SBI, it may be any commercial bank, it may be private or public. Okay, so it has to maintain some portion within the RBI in the form of cash reserve ratio. Okay, now when there is a inflation, so you inflation. What is inflation? When there is a when liquidity is high. Okay, and when there is money supply is high, and in equivalent to that there is no creation of goods and service, no, that leads to the inflation. There is money within the people, more money, but in equivalent to that there is no creation of goods and services. Okay, that will lead to inflation. Now to control inflation, so what RBI will do? RBI will increase CRR. To control inflation, RBI will increase CRR. Okay, so when RBI will increase CRR, there will be less money available with the banks. As a result, bank will also give less loan. Okay, and ultimately when bank will give less loan, there will be less economic activities, or ultimately less money or will be in the public. Okay, so this will decrease the demand. So to control liquidity, RBI will increase the cash reserve ratio. But RBI cannot increase CRR for a long time. It will impact growth. Okay, so again when inflation will control, no, then RBI will again decrease the CRR. So RBI will decrease CRR. So in order to promote growth, RBI will decrease CRR. Why? Because when RBI will decrease CRR, then there will be more money. So money will now come out from the RBI to the other banks. Okay, or it may be SBI or any commercial bank. Then there will be more money with the banking system, and when there will be more money with the banking system, bank will be able to give more loan. There will be more economic activities, more employment generation, and when there will be more employment generation, then the demand it will also increase the purchasing power. Okay, purchasing power of the people. When purchasing power will increase, it will increase demand. Okay, so this will, when there is an increase in demand, definitely it will lead to an increase in production, which will ultimately promote growth. Okay, so in order to promote growth, RBI will decrease CRR, whereas in order to promote control inflations, RBI will so in order to control inflations, RBI will increase CRR. Okay, so this is all for today, and in the next class I will discuss in details remaining portions, and I will also solve some MCQs, because solving MCQ is very important. Okay, so when we will solve MCQs, then we will be able to understand whether we are able to understand the topic clearly, whether we have the clarity in the particular topic or not. Okay, thank you.